Volatility spiked this past week with equities moving on China, the U.S. economy, and a 10% jump in oil prices. But is the roller coaster ride over, or are we just beginning? David Sykes, portfolio manager of the TD Tactical and U.S. Monthly Income Funds. Welcome, David.
Thanks for having me.
So what do you think? We've had a pretty rough week. Is this the end of it, or is there more to come?
Well, let's try and analyze what caused the volatility this week. And I think what you have to really do is step back and realize we've been spoiled. The last 4 or 5 years have been really amazing returns.
Very low volatility.
Really amazing returns with very low volatility. And so if you think about what caused this current volatility, really it's a slowing global growth profile. Primarily China. The devaluation of the yuan caused some people to worry about global growth, which then causes you to worry about corporate profits. Corporate profits, the growth is decelerating in the United States. There's, a thought that the Fed is going to raise interest rates. Maybe it's September, maybe it's December. But until some of these issues get resolved, yes, there's going to be volatility. But I think what people need to remember is this is very normal. I think the last number of years with the low volatility is abnormal. Volatility is normal, and it's part of investing. It's part of equities.
So is this just a correction?
Well, that's a great question, and we were down 12, 13% in a very short period of time. So it certainly felt severe. It certainly felt scary. I mean, it always scares the bejeepers out of you when you see things happen that fast. My guess is that there's probably a little bit more volatility to come in the fall. But if you're looking for an accurate prediction for the next week, I'm not your guy. What we like to do is look out 2, 3, 4, 5 years and try and focus on high quality stocks that pay dividends and grow those dividends. But traditionally in September, October, you do get some volatility. And certainly all those issues I talked about, slowing Chinese growth, the Fed will they not raise rates, issues in Europe, those aren't going to go away anytime soon.
Now, with all this volatility, there's usually some buying opportunities if you're sharp and you get in there. Have you found anything?
Yeah, certainly the market has come down 10, 12% in a very short order of time, but there's been some other individual stocks that have come down more, and ones that we think are quite interesting. Now, I have 2 names for you today, but remember, I always think about this through the lens of a checklist that I want to make sure I perform. So for me, businesses have to have a competitive advantage, something they do better than everybody else. They have to have a growth strategy. They have to have a really strong balance sheet. They have to generate free cash flow. And fifth and finally, they have to pay a dividend and grow that dividend. So ones for us that look quite attractive now, one is ConocoPhillips. Now this is an integrated, it used to be an integrated oil company. They have spun off their downstream assets, and it's now purely an E&P, exploration and production company in the energy sector. It's an interesting play in the fact that they have a 6.5% dividend yield. Now, normally that would alert you to the fact that maybe that dividend yield's too high, and there might be a dividend cut coming. But we've done the work. We believe that they could actually make it through this lower for longer oil period. They have a couple of key projects, one in Australia, one in northern Alberta. They're about to wrap up. That's going to really open up their cash flow. Their CapEx was running at about $16 billion. That's going to be reduced to $11 billion. It's going to free up about $5 billion of capital. We think they're going to grow production somewhere in the line of 1 to 2%. That's going to fuel a little bit of dividend growth over the next few years. It's come down, a year ago this was a $95 stock. Before the most recent turmoil, it was about a $70 stock. Now we're in the 40s, mid-40s range. We think this is quite attractive.
So is it one of these companies that can still operate in this low oil environment? Yeah,
one of its competitive advantages is the fact that they do have low-cost assets. They do have assets throughout the world. One of the other nice advantages with this company is 85% of the production comes from politically stable areas. It comes from the United States, Canada, Alaska, Europe. It's not in geopolitical hotspots, so we like that quite a bit. It has a 15-year reserve life, so lots of assets to extract. And it's not one that's going to be a hyper-growth type of profile, but it's one that's going to give us a very nice, juicy yield today that we think is sustainable, and they'll continue to ramp that dividend up slowly over time. But in what we think is going to be a very slow growth environment, muted returns in equities, we think this is one that we should hold.
And I like the next one you brought, Tiffany's.
Yeah, so it's an interesting one. Tiffany. Tiffany's not a mega cap stock. It's about an $11 billion market cap company. It is, though, in my estimation, very blue chip. If you think about the competitive advantage, that checklist I talked about earlier, Tiffany really does have that cachet, that luxury brand status, and they've done very well. They do have lots of growth. They have about 300 stores globally at the moment. Roughly half of those would be in North America, half outside of North America. The big growth area there is China. and it's the emerging markets. Now, of course, that's today's concern, but for me, that's today's opportunity. So again, I'm not forecasting that Tiffany's sales will increase next week in China, but over the next 2, 3, 4 years, I think you're going to get nice store growth in the Chinese market. The third thing that they really have going for them is a balance sheet. When you have tough times like today and this week, you really want to make sure you don't have a lot of debt. And Tiffany's got a very strong balance sheet. They can weather this storm. They generate lots of free cash flow, and they've paid a really nice dividend and grown it for the last 25 years. Right now, the dividend yield's about 2%. This is a company that we think will grow same-store sales something like 2 to 3%. They'll have square footage growth of 2 or 3%. Gives you a 5 or 6% top line, 10 to 12% earnings growth, and we think that's very attractive with the dividend growth that they're going to be able to generate.
So some weakness now, but hopefully not forever.
Yeah, and as you said earlier, these are volatile times, but if you're doing your work properly and you focus on your checklist, these are times where you can add to positions or perhaps start new ones.
Thank you very much, David.
You're welcome.
I'm Marianne Devenny. I've been joined by David Sykes, Portfolio Manager from TD Asset Management. Thanks for watching.